When you go to business school, you learn to use a model called Porter's Five Forces to evaluate the competitiveness of an industry. Two of those forces are threat of new entrants and threat of substitutes. This is relevant in what we're seeing play out in the AI semiconductor industry today with Nvidia and Google. Basically, Google's TPU semiconductors are emerging as a substitute or new entrant to some of the GPU semiconductors that Nvidia has been selling like hotcakes for AI workloads. Google's TPU business is shaking up the AI trade, and the company more broadly is firing on all cylinders. The TPU business is certainly one of the catalysts behind the stock's more than 80+% rise over the last 6 months. Just a few weeks ago, their CEO Sundar Pichai was talking about this in the earnings call, saying how they're investing in TPU capacity because of tremendous demand from customers like Anthropic, who are looking to access up to 1 million TPUs. Then a few weeks later, we find out from Meta that they're looking to get their hands on some TPUs for their data center and or rent them through Google's cloud business. And in case you're wondering, a TPU is a tensor processing unit, basically a semiconductor chip purpose-built for AI, but limited to that focus. With GPUs, you get more flexibility, but they're more energy intensive, which we know is a big challenge for AI compute. On the flip side, Nvidia's stock is now down about 5% in the 3-month chart, partially due to TPUs threatening entrance or substitution. If you've been following our notes, you know that lately we've been digging into the risks to Nvidia's business, namely concerns around an AI bubble or at least a CapEx bubble. That said, the threat of a new entrant or substitute product is always something to watch out for. This doesn't really worry us about Nvidia, who will still grow significantly even if they have to yield some market share to AMD and Google. This does, however, excite us about Google, a name that we've been on over the last several quarters. We're more concerned with the bigger potential risks out there that would impact all players, like a pullback in CapEx, the debt overhang, compute hoarding, or even the general question around AI's potential profitability. Thanks, guys. As always, we'll continue to keep you posted on our thoughts as the market evolves. Be good.